Welcome, everyone. Good morning, good afternoon, wherever you are based in the world. Thank you so much for joining this session today. For me, it's 6 p.m. I'm based in London, and my name is Clarisse. I'm really pleased to be invited by Taking Root and to be here today to moderate this panel discussion on the topic of community-led carbon projects and their importance in the voluntary carbon market. So the title for the session today is Unlocking Capital for Scale. How can community-led carbon projects raise capital to create high integrity impacts? I'm super pleased to be joined by three fantastic panelists representing project developers and investors in the voluntary carbon market space in the nature-based solutions sector. And they will be sharing their perspectives about the role of community projects, of smallholder projects in the VCM, the very particular potential that these projects have to deliver immense benefits to remove carbon, to restore nature, and improve livelihoods. And also, they will be sharing perspectives about how to unlock that potential through private investment. So, in terms of structure for this session, we're going to have about 45 minutes to an hour of panel discussion. So we'll be turning to our panelists and I will open the floor. And we will also have perhaps 20 minutes or a little bit more of Q&A time with you, with the audience. So please feel free to ask some questions. Use the chat function that you're currently seeing on the screen to react, share any comments or remarks, and respond to whatever you're hearing that's interesting from our panelists. And we'll get the chance to to answer some of your questions towards the end. So before I turn to our panelists, I just want to briefly introduce myself and give some brief opening remarks to set the scene for the discussion. So I work for Bregal Sphere, which is the new impact investing platform of Bregal Investments. It's a new natural capital strategy, new natural capital investing platform. And earlier in 2024, we announced a nature strategy, which focuses on deploying capital to address the financing gap for nature and investing in nature based solutions projects through the voluntary carbon market. In 2022, Bregal also acquired a project development company called Pure, a French developer of NBS projects, and Pure specialize in developing agroforestry and reforestation with smallholder farmers across the world. So this topic of community-led projects and smallholder projects is something that is very relevant to us at Bregal and very relevant for our panelists as well. So when thinking about the topic for today, my question that I asked myself was, what is the role that small community-led projects play in the VCM? How do they fit? How did they fit in the past, and how do they fit at the moment present? We know that smallholder farmers, for example, play a very critical role in global food systems and in managing natural resources that we all depend on, that our economies depend on. But we also know that local communities and smallholder farmers are not getting enough financing that they need to continue to sustainably manage the resources, to continue to produce food that underpin global agricultural value chains. And the voluntary carbon market actually was created with this idea that communities or smallholder farmers could earn an income through carbon finance by growing trees on their land and by sequestering carbon. But however, these kinds of projects, the smallholder-led projects, the community projects, have been stereotyped in the market. And currently, we're seeing a lot more large-scale commercial projects developed by more professionalized project proponents, perhaps based on strategies that are large-scale land acquisition strategies as opposed to partnering with smallholders and local communities. And so these small community projects yeah, are victim of stereotypes, and we think of them as being small, being inefficient, costly, or risky. And they have traditionally been associated with philanthropy or with development assistance. So, what we want to be discussing today is we want to be dispelling the myths that smallholder projects and community projects are too small and incompatible with private investment and commercial capital. Quite on the opposite, we think, or our panelists will also give their views on that, that small projects, that community-led projects lend themselves really well to investor capital, and that there are investors that exist in this space who are looking for these bigger impacts that community-led projects bring to climate adaptation, to food security, and to the resilience of agricultural supply chains, and that it's not just about sequestering carbon, that we can achieve a lot more. So what we will be discussing today is we'll dig into what quality means to investors that are looking to deploy capital within carbon projects. So we know that quality and integrity has often been discussed in the context of carbon credits that must represent real, measurable, quantifiable mitigation. So the idea that one carbon credit must equal 1 ton of CO2 sequestered or avoided. But we'll see that quality also has a very particular meaning when we talk about social safeguards, equity, and engagement with local communities. We'll also be talking about the challenges that community-led projects face and how an equitable approach to project development leads to higher integrity impacts, to bigger impacts, both for project developers, for the communities involved, and also for investors. And we'll also be suggesting some best practices for projects that are looking to raise investor capital to scale their climate, nature, and social impacts. So I would now like to invite our panelists to introduce themselves and the organization that they're representing. And also, yeah, just some brief thoughts to begin with on how you are coming across community-led projects or smallholder projects in your work. And I will first turn to Khalil, then Victoria, and Jessica. Thank you.
Thank you, and good afternoon or good evening, everyone. It's such a pleasure to be here and to share the stage with this wonderful group. My name is Khalil Baker. I'm the founder and CEO of Taking Root. We are an organization that grows trees with smallholder farmers. We've been doing this with the Plan Vivo standard since 2010, working predominantly in Nicaragua, where we started, and have sort of scaled to a number of other countries. We started off in Nicaragua in 2010 with just 20 farmers on about 40 hectares of land, very much as a smallholder project. And over the years have been fortunate enough to be able to scale the project. It is now the single largest reforestation initiative in Nicaragua, possibly all of Central America. And what's amazing about it is it's by scale, it is working with thousands and thousands of relatively small landowners. And so, if anything, working with smallholder farmers does not have to mean small impact. In fact, I believe, and we'll talk about in this presentation, it's actually one of the most effective ways of achieving a scale at high integrity. I have a background in forestry, forestry and economics, and it's a lens that we take to everything I do. So without further ado, thank you very much. It's a real pleasure to be here with everyone today.
So I guess it's my turn now. Thanks everyone, and thank you Taking Root for inviting me as well on this panel. So my name is Victoria Labourdette. I'm French, based in Paris, and I'm a project director at Hummingbirds. So Hummingbirds, we are developer and investor in a carbon-based project. We're looking at a whole bunch of different kind of project, from conservation to restoration of different ecosystems, to tropical forest to dry forest, but also wetlands and coastal ecosystems. And we are also from time to time looking at some opportunities in the improved cook stove kind of project. And so we have kind of a mixed position in the way that the real purpose and DNA of the company is to help the markets have access to more high quality and high integrity project. I guess it's the whole topic of this panel and session. We are bringing technical and financial support for the whole designing phase, and bringing bridge financing as well for the first years of implementation of the project when it's kind of hard to go and get signing some long-term emission reduction purchase agreement, for example, to be able to kickstart the project. So that's really where we have our added value. And we have 7 offices across the world, because the idea is to have our company be as close as possible from the project we are developing, to make sure that we have long-lasting and trustworthy partnership with our local partners, who are the implementers and operators of the project. Whether it is communities or private companies, NGOs, it really depends on the actors and the stakeholders that are engaged in the project, where the project is, and the nature of the project, of course. Thanks a lot.
Okay, I'll take it from here. Thank you, Clarisse, and to my fellow panelists, and also to the hosts of today's event. Really happy to be here. I am the Director of Natural Climate Solutions at Mercuria Energy Trading. Mercuria is the 3rd largest privately owned energy trading company globally. It is based in Switzerland. There are 25 offices globally with a headcount of approximately 1,400. Mercuria covers a wide variety of commodity markets globally. And then in 2021, Mercuria pledged that 50% of all of our investment capital will go into low carbon sectors by 2025. At the end of 2022, we were well ahead of that commitment. And then in 2023, Mercuria announced Sylvania. Sylvania is a $500 million nature investment vehicle, which focuses on restoration and protection of land and forests. And a large part of that investment is focused on carbon offset projects. And we already have significant investments as examples. To provide you with some examples, we have a portfolio of forest restoration projects, working with ejidos, which are community forest owners in Mexico. We have a portfolio of family forest projects in the US, improved forest management projects in particular. We have community-led RED projects in Peru, as well as 2 jurisdictional scale RED programs in 2 provinces in South America. And then in addition, our investments also include equity investments in companies that enable this work, so project development companies, for example, as well as real assets, for example, land assets. Thank you.
Thank you to all 3 of you for sharing these initial remarks. Now, my first question to you would be, can you elaborate a little bit more on this idea that of integrity, of quality and integrity? So everyone in the market, in the VCM, in the NBS sector is looking for supposedly high quality and high integrity projects. From your perspective and from your experience working in your respective organizations, what does high integrity mean for those who are looking to invest in natural climate solutions? Perhaps if Jessica and Victoria can go first. Yeah.
I can take that if you want. I can take a stab. As investors, there's a number of things. We conduct pretty significant due diligence before making any investments, and integrity is very central to any investment that we make. So first, we make sure that there is an offset standard that is of high integrity, like Plan Vivo or similar. And then to some extent, we do kind of look towards that alphabet soup of labels and certifications, because that's definitely something that the market has signaled interest in. So, as a measure of integrity. And many market participants have looked towards those things, and so we do see that it impacts pricing as well. So that includes the ICBCM, ICROA, CORSIA, CCB, etc. So those are important to buyers, so those are important to investors as well. But then also as investors, we tend to dive into the details of the project design in a pretty detailed manner to make sure that they're designed in a robust manner in our view. And so the things that we look into is the quantification and accuracy of estimates for emission reductions, baseline setting to ensure that it's rigorous and conservative. Many market participants will question the integrity of a baseline, so we really dig into that. We dig very much into community engagement and benefit sharing plans and make sure that there's robust project activities in place and very, very solid oversight and management on the ground. I think those are extraordinarily key. We also look at the sustainability of project activities and design. So we want to make sure that there's multiple income streams or multiple benefits from project activities and a very clear path to long-term success. And then of course we look at environmental benefits. So are there biodiversity benefits? Is there planting of native species and so on. So those are kind of the key things that we'll look at in our DD process.
And well, I'm fully aligned with what Jessica said, and thank you very much. I might add maybe that forest integrity indeed starts really from the designing phases of the project and the concept, how it was designed, and how does the people that will be affected by the project were involved or not in this design as well. I'm talking about people, but it's also the case for the whole biotic and abiotic also parameters of what surrounds the project. So I'd say that high integrity is about, we want to check as much as possible how holistic the project is, not only focusing on carbon, but really on everything geographically, but also in time that will be affected by the project, and how this time component is also integrated. That's also part of the due diligence that Jessica was mentioning. How do we make sure that the project we are investing in now will be permanent, will deliver the performance we are expecting it to deliver, of course, because we are talking about long-term kind of projects. So we don't want it to be high integrity just at the time of the investment, but we want it to be high integrity during those 20, 30 years of the project. And to check that, so beside the whole designing phase, the due diligence, if we're deep diving a little bit into the community aspect of it, land tenure is always kind of a challenge for community or smallholder projects. So this is something we focus a lot on, and also trying to always ask what's beyond the carbon, so the resilience of the project during the project and after the project. So after those 20, 30, 40 years, what happens? How do we make sure that all those benefits, co-benefits, and all the impact that the project had will continue, and they will not be kind of a reverse effect at the end of this project? So high integrity shall be seen as, well, geographically, in terms of stakeholders, social, environmental, and climate, of course, benefits, but also the time the project is and what's beyond this project.
That makes a lot of sense. And you really highlighted the fact that to have quality tradable carbon units, to have quality credits, you really need to think about project design from the very beginning. And this starts with having a very clear value proposition with the stakeholders you're trying to engage. And that starts from day one, not when you're actually trying to sell the credits to an interested buyer. So coming to the topic of today, which is around community projects and smallholder projects, what are your perspectives around the role that community projects play in fulfilling that desire for quality and integrity that investors are looking for? Um, Perhaps, yeah, how do these kinds of projects, the smaller projects as opposed to perhaps the large scale, more commercial projects, how do they lend themselves well to this integrity pursuit, let's say? Perhaps Khalil.
Yeah, for sure. And I will touch a little bit on scale as well. If we think about the actual problem that we're trying to solve, right? We're talking accelerating the restoration of the natural world. And that's a big, big problem that's urgently needed. And if you look at the scale of this problem, it's big, right? So ultimately, let's not lose sight of we want to do large scale nature restoration. to do that, if you look at like the priority areas of the world where there's the most potential, and then you look at the distribution of land control or land influence, the land stewards of it, you're not going to find that most of this land is owned by large corporations. In fact, if you take a truly landscape approach, people who are managing these lands are really, really, really diverse. You've got communities, you have private landowners, you have government owned land, and I don't think you can think, oh, it's just one group that's going to solve this problem. You really have to take it from a landscape holistic approach. And family farmers are the most numerous land stewards on this planet. And in the areas of like in the tropics where there's the greatest potential, they are actually the greatest quantity in terms of area that they manage. So you can't really address the solution at scale without including a community approach. That's first and foremost. If we don't figure out how to do community smallholder farmers, include them into that solution, we won't actually solve the solution. And so they have so much potential just in terms of scale. But there's many important other things that I think lend themselves extremely well to integrity at doing this at scale. First and foremost, if you look at what individual landowners favor in terms of the trees that they want to grow, they almost always prefer a diversity of native tree species, much more than exotic tree species. And so already, if you talk about preferences of lots and lots and lots of individual people, you'll get diversity. And diversity is a big part of what we want, especially when we're talking about biodiversity. And so this is why when you got community smallholder projects, they tend to bring a much, much, much greater diversity of tree species, of functions into the landscape. Uh, Furthermore, this plays a huge role in terms of durability or permanence, what some people call permanence. I prefer the term durability. And that's just because they are so diverse, right? Like if you think of it from a pure investment perspective, you think about it a portfolio perspective, when you've got thousands and thousands of participants, you can't burn all of that down. They can't all change that mountain. The risk is so spread on such a large population that you get sort of like the law of large numbers. And these actually make some of the most resilient projects. They make some of the most diverse projects. I think they're some of the most scalable projects. And I think they play the best on diversity. And then you can go on to the social factor of things, which also I think plays an important role, of course, just in terms of like equity, but I also think that equity plays an important role in durability. If communities are really truly bought in to the work that they're doing, they have an invested interest and ownership in its success and its longevity. And that's really, really, really powerful. That's something that you just can't get unless you have broad-based participation. So just to summarize, I think these community projects working with smallholder farmers or private landowners offers the greatest potential in terms of scale. I think they offer some of the best solutions in terms of diversity of species, which then by extension, biodiversity, and then in terms of durability.
If I can add maybe on our side, for hummingbirds and in our portfolio, community project takes more and more places as time goes by because unfortunately there is less and less areas in the world where nobody relies on a plot of a forest or a plot of a natural ecosystem. So we are in this also climate crisis because of we cannot look anymore at an only purpose concept of an area. We are really looking at having a multi-purpose areas because those communities are the guardians and they live through this forest or any other kind of ecosystems. So, of course, we want to do restoration where there is pristine ecosystems because we don't want them to see them go up in flames. But we also have to work with the people who have already degraded the ecosystem, but still needs to have economic value chains to be able to have subsistence farmings and to live until tomorrow. And well, even longer, looking at the longer term, looking at how to have sustainable production in economic value chains. And so this working with communities is really helpful in the sense that they get how urgent the matter is, because when you talk to them in the matter of a lifetime, not even going from one generation to another, but just in the matter of the one lifetime, they've seen how the ecosystems were before and how prosperous the community could be compared to how it is now when there is a degraded ecosystem. So they really get the importance of protecting what's left, restoring what has been degraded, while trying to develop even further the different economic activities they're looking at. So for us, it's a bit the main purpose of the carbon finance being enhancing a behavioral change from one generation to another, to go from one only purpose area to enhancing multi-purpose areas in a sustainable way. That's really what we think the natural and carbon finance was initially also made, and the place it has in our portfolio is just major, because we cannot ignore anymore people that doesn't have their natural resources that they used to develop their communities, economic value chains, and in the end, survival resources.
Yeah, no, these are completely valid points. And I do think there is a really strong business case for investors to invest specifically in the smaller scale projects, in the smallholder agriculture projects, because they do deliver these additional benefits that are that have been branded by the VCM as co-benefits, and perhaps wrongly so. I sometimes get a bit frustrated by hearing about this phrase strong co-benefits for livelihoods and biodiversity. But essentially what we're talking here, what you've laid out, is their core benefits, right? They make it, they make a case for why food and agricultural companies themselves should reallocate funds or finance towards the producer communities or the smallholders at origin in their sourcing landscapes, to really improve the way that the crops are grown, or renovate agroforestry systems, add more shade trees, etc. And this can be done as well through the carbon markets. um, but yeah, so the opportunities, I think these are quite clear. But what about the challenges? I think today it's true. um, I don't think that small community-led projects are sufficiently recognized in the voluntary carbon market. And there have been efforts, initiatives such as that of those of Plan Vivo, to really champion community-led projects and empower them through the carbon markets, helping them access carbon finance. But what are the challenges? Do you agree when I say to you that people think and investors think that smallholder projects, community projects, are small, too risky, too distributed across a landscape instead of being kind of one contiguous area, and inefficient? Or perhaps, yeah, elaborate a little bit more on the challenges that you're seeing from your perspective.
I'm happy to maybe to jump in first as the project developer in this case. I think it's true. Like ultimately, there are huge benefits to engaging with local populations and lots of different private landowners, like we talked about. Those bring tons of benefits, but it is inevitably different. And I think part of that difference, part of it is really just getting used to understanding that they operate differently, and there's a certain degree of familiarity that the investment community needs to get used to, and may not have had as many opportunities to get exposed to it. And this doesn't mean better or worse. They are clearly just different. But there are also unique challenges. Inevitably, if you're going to work on the landscape level with thousands and thousands of parcels of land, there are added complexities for sure. And these complexities can raise costs, and they can lead to vulnerabilities if not well managed. However, really amazing strategies can and do exist. And I think they're also can be some of the most successful projects. And so we ought to look to these examples of success and look to replicate them. I'm going to try and give some examples to make this as concrete and specific as possible. I'm speaking from my own experience. In particular, if you are working with thousands and thousands of parcels of land, as opposed to one or two large contiguous ones, the recruitment of new areas is more complicated, right? You have to travel farther distances to find more people, to verify their land tenure, like Victoria was talking about, to make sure that's in place. You need to sign agreements with tons of different people. That is more complicated than identifying and signing a single agreement versus doing it thousands and thousands continuously. After that, once land is recruited, you need to oversee and manage for the tree growth. There is no way it doesn't come with added complexities managing the tree growth on thousands of parcels of land compared to a single one, especially if you're comparing it to a monoculture of equally spaced trees. Like, that is managerially more simple than doing it on thousands of property. Let's be real. Finally, we talked about parts of integrity and quantifying the carbon accurately, quantifying the carbon across such heterogeneity, which is the biodiversity element that we liked, but across the landscape as so many different parcels is inherently more complex. So these are challenges that I think are core, that are real to the system. But there are amazing solutions, and I want to speak a little bit to some of those in these 3 cases. And really, part of it is like going back to the beginning. It's about a different way of looking at the problem to understand solutions to it. And if you don't approach it in the beginning with a bit of an open mind, like, there's more than 2 ways, more than one way of doing things, it's hard to go on that journey. So let's start with recruitment. You've got to recruit thousands of parcels of land. What I have found in successful projects, like the ones that Take Root operate, but I've seen other project developers in the ecosystem do this as well, is that you always have to leverage existing community infrastructure. Humans are organized into groups through some level of the existing social fabric. It is different in different cases, and you have to adapt to that, but I will give some examples. In some communities, they're really connected to their local religious institution or the church, for example. So in like Nicaragua, people attend church, and there's this aggregation of people, or there's community leadership meetings that take place, and there's these existing forums where people are coming together. And so we connect our recruitment strategies to that existing social infrastructure. And so while individual parcels are recruited individually, the process of recruitment leverages the social fabric to get to it at scale. Initially, it's a little bit like the snowball effect, where it is hard to penetrate a new region. There's unfamiliarity, there's like resistance to the unknown, and while you reach a lot of people, there's a slow adoption rate of the program. Over time, people observe the success of their neighbors, and they start saying, "Hey, that sounds cool. How did you participate in that?" And they say, "Oh, hey, I'm part of this program. By the way, you can participate too." And then they tell them about it. And after that, you start building like this critical mass. It comes to a point where it changes an entire region's perception of what exists and what is possible, and the community literally starts recruiting itself. And so you end up this effect where it ends up becoming part of the social fabric, and all of a sudden your facility of recruitment just drastically drops. And in these aggregated projects, there's way less of seeing the community recruit itself, what you see in these things. This is a bit of a flywheel that you have to build, and it takes time, and you have to start over every time. But just this is one of those strategies that can really drastically improve and simplify the processes of recruitment. And this is a very human process, right? And I'm emphasizing this because I'll also talk a little bit about the role of technology. And I always think it's important to couch the topic of technology in the recognition that it plays its function that's separate and complementary to the social fabric of society. And one is not a substitute for the other. They really have to go together. Management. So you need to oversee some degree of logistics and oversight and management so that the trees are being grown. And this is a way where at Taking Root, we have highly leveraged the use of simple technologies and the sort of cloud computing, the sort of invisible technology infrastructure that is used to automate as many processes as possible and to bring super localized information in simple formats. And so, for example, in our project, you'll have within a community, you'll have a group of farmers that are linked to what we call a community technician. So it's a project representative in the community whose job is to provide training and information to that group. And this is one way where like an individual can get super informed information and highly targeted effective management insights by automating processes. I will connect this back to the third one around forest inventory, and then connect it back to management. You can see the role of community and technology to make these effective. After that, if you want to do forest inventory and you want to quantify carbon impacts highly rigorously, it's a lot of work, right? You've got to measure a lot of trees. You've got to identify the species. You have to find the respective which are called like above ground biomass equations, things that convert tree measurements into total biomass. You then have to calculate that biomass information into carbon or carbon dioxide equivalents. You have to take into account subtracting baselines, which are increasingly dynamic and thus more complicated. You have to put after risk buffers. You have to do discounts for all sorts of things. You realize that you just have a sample, so you have some statistics and extrapolation, and this is complicated. And so like to expect a local community in rural areas to be able to have these skills and be able to do it is setting yourself up for a really costly, long process. And this is something that we have completely automated. So humans are still on the ground identifying tree species because this is done by humans and collecting simple measurements, and the rest of the process is completely automated to create completely traceable carbon impacts that ends up helping convince people of the integrity of that impact. But at the same time, because we have that information used to quantify carbon, it also tells us which trees are growing better than other trees. What areas are performing better than average versus below the average? And what do those things have in common? And that information is what we repurpose to develop management insights, which is back to what the second one I was talking about. And we end up finding crazy correlations that are like mind blowing at times. But then you can distill into these really simple insights to bring to people so that while your management is more complicated, we can actually make it more effective and more targeted because it's more informed. Some of the stuff is like super simple. Like we've noticed that proximity to roads really correlates with tree growth, which is a really strange correlation you might think at first, but it's a lot easier to see it. And what is measured is managed, or what is observed is improved. And to go, okay, we have a total bias for quality closer to more accessible areas. And so how do we inform our recruitment as a function of that of new areas to focus accessibility versus how do we apply different management techniques for things that are farther from roads, as an example. We also find crazy correlations between individuals and performance. So the community technician that's working with a group of farmers, the differential in performance, the average performance of the group of farmers that are overseen by one community technician can be 300% better than another community technician. And so this inevitably makes you ask questions. What is this person doing to be so much more effective than everyone else? And even that question is so powerful because then it allows you to dig in. And I'll give you just a for example from our own experience that was just so fascinating. Is we went through the data and then I said, I want to speak to our like star community technicians because the performance impacts of this individual were insane. Like it was just insane compared to, I said, like 300% better performance. And so I was gonna go meet this person, and I immediately built an image in my mind of the person that I was gonna go meet. I had this view of what this person was gonna look like, and I imagined a very athletic person, super driven, who was super productive, who just spoke to people all the time. And then when I met the person, he didn't look anything like that. He like completely couldn't have looked more different than how I imagined the person. And in conversation, meeting with him, this person in particular previously was a pastor in a church, and he was exceptional at connecting with people and creating a feeling of belonging. And through his capacity training, which kind of resembled sermons more than anything, he was really able to engage people into the process. He becomes like the leaders of their own farms and their own performance. And it was just one of those areas where like these types of insights, I don't know how we would have gone without it, but just lead to like amazing outcomes. So these are just some of the ways that you have to take a different approach to managing these programs. These different approaches, I think, are super powerful, but they're also different. There's some getting used to that.
Thanks for sharing,
I
Khalil.
could
This sounds like really interesting and valuable learnings. Jessica and Victoria, do any of these challenges resonate with you, or do you see any additional difficulties with smallholder or community-led projects trying to access investor capital?
I can jump in. I mean, my observations are much more high level. Khalil has way more on the ground experience than what we're currently doing, but everything that he said really resonated very much with what we've observed with our investments and with other things that we haven't invested in, that have probably not been able to overcome some of the challenges that he pointed out. But these are hard projects to manage, and no one knows that better than Khalil. And that's because a lot of times they have very high costs. It's very difficult to. Can you hear me still?
Yes.
Okay.
Yeah.
I think I lost everyone for a second. Okay. It's very hard to deliver results on the ground with a lot of different individuals with long distances between them. As Khalil mentioned, recruitment can be a big challenge. Planting trees itself is very hard. There can be a lack of seedlings or poor seedling quality, or nurseries that are very far apart. There can be high mortality if you don't use the seedlings or if they're not properly cared for. Administratively, it's extremely difficult. There's access issues in remote areas. You're sometimes dealing with communities that have very low capacity, and that has to be also handled. There's just inherent logistical challenges. There can be cultural challenges, but we feel like well-designed projects can attack and address all of these, but it is a challenge. So it's very important to have, in terms of the solutions, super strong teams on the ground, super strong development capacity on the ground, and obviously, the international developers as well that are helping finance these programs. But so much is going to be related to, I think, streamlining approaches in every respect, to cut costs and to enable that scaling that's absolutely needed to, first of all, drive the impact, but also to, generate enough income to keep on to keep on making those important income benefits. And that includes, as Khalil mentioned, leveraging technology on several fronts. So that's from, remote sensing approaches for MRV, platforms for enabling and improving, reporting and administration. And then I think really key to what he said, and we've taken note of that too, is creating kind of networks of experts on the ground within your own teams, but also working with local partners who already understand the local conditions, already have local programs with networks of locals in place. That's absolutely essential. I mean, in general, leveraging what NGOs are doing on the ground and things like that can really be helpful, and we've taken note of that. But also, I think Khalil's point is very important, which is taking the learnings, like making it an iterative process where every time you might make a mistake, you not just fix it that once, but you fix it for every single instance going forward. So you're constantly looking at ways for improving and then taking that on board. And I think that's really key as well.
I cannot but agree with what Jessica and Khalil said, and indeed, just to bounce on this.
I think Victoria, you may have a sound issue coming. Try again.
Yeah. Sorry, can you hear me now?
Yes.
Yes.
Thanks.
Okay, I was just agreeing with what Jessica and Khalil was saying, and to bounce back on this last topic about the flexibility, I might want to add the idea of knowledge that the community and smallholder farmers have compared to projects where we have a big concession or big chunk of land, and well, we can start from scratch somehow. While working with communities, we're working on knowledge that has hundreds of years, and they don't necessarily put scientific concepts or names behind why they do something or why they don't want to do something, but it's just empiric knowledge, and that just can make a project accelerate a lot in the end, rather than making some errors by saying, I want to plant this because on the paper, this species is suitable, it's best for this kind of project, etc., etc. Whereas you just go with someone and ask, and well, they will tell you that they have already tried for the past 2 generations to do so, but for whatever reason, this tree doesn't grow, or in the end, they don't manage to value it properly. So this is really powerful. Of course, it's really hard to monetize and to value, but when you work with communities or with smallholder farmers, you're just valorizing this whole knowledge package that comes with it. And for the scalability, again, it's massive. Because again, if I oppose it a little bit to having private land, well, your land is delimited. You have 20,000 hectares, 10,000, or how many hectares, but you cannot outgrow a little bit the boundaries of your project area. While working with communities as smallholder, the word of mouth is something really powerful. So indeed, you start slow because you have to convince them. It's a lot of energy, it's a lot of patience and passion to put into that. But once the others can see that it has an impact, that the people living there are happy and want to pursue it, I mean, the scalability is almost limitless. Taking into account, of course, what has been said about improving the technology to counterbalance the cost of logistic and supply that comes with having projects that are spread across bigger areas. But scalability for community and smallholder project might be much more interesting than what can be found on private owned land project, for example.
The word of mouth, that is indeed very, very important, and it can really go the other way as well, right? For a project which is perceived as being inequitable, it'll go around the local community, and then the neighbors might start dropping out of the project, and that's how you kind of end up on the front page of the Guardian or something. So really agree with what you shared, and perhaps from, yeah, on the point of investor education as well, I think that is really important. Um, there are a lot of there are some investors that are approaching these smaller community-led projects with kind of the wrong mindset. So thinking that they can control the long-term permanence of the carbon in the same way as with large-scale land acquisition type projects. So by mandating really stringent agreements with local communities, getting them to restricting the access to the area, for example, or limiting the land use activities that they're able to have in the project area. But these are essentially making people worse off. So really looking at the equity side of the project design, and not and the do no harm principle, which is so fundamental, that I would add as well. um, but perhaps that brings us to the next topic, which is on the alignment of incentives and benefit sharing. How can we create equitable arrangements that align everyone? So both the project developers, the local communities, the project participants, and the investors. Um, so benefit sharing is often being talked about in the context of the VCM. I do think that perhaps we are just about to move away from that terminology, as it maybe has been inherited from older old world infrastructure projects, mining, oil and gas as well. But here, what we're talking about is creating equitable arrangements, and perhaps revenue sharing when it comes to carbon revenues. So I would love to ask our panelists their views on how to create those equitable carbon revenue sharing arrangements or benefit sharing arrangements. How have they seen that play out in their work?
I'm happy to start if you want. I mean, in our view and in our experience, if you're working with communities, then communities are the ones that need to be empowered and enabled to be the stewards of the land, right? And to either plant trees in a sustainable manner or to protect existing forests, whatever the activity is. So in order to do that, we recognize that a large percentage of revenue really has to go back into the communities. And the way that that's spent also has to be, obviously some of it probably has to cover project activities in every instance, but the rest has to be kind of designated through a participatory process as well, so that really, communities need to be engaged and empowered at every step of the way. And so we recognize that that's important. But Mercuria and other investors, we're that's the downside, I guess, of working with the private sector is that we do need a return. This isn't free money. We're not philanthropists, so we do need a return. So, for us, on one hand, we do provide a lot of flexibility in the way we structure deals and the way we invest upfront. and an investment size. And we also, in Mercuria in particular, can take on quite a lot of risk, but we do need a return, and it's part of my job to make sure that we get that return, because from the project, we have to make sure that it's got the integrity and the right systems in place to generate the credits and to be successful. And so that comes back to kind of what I've said before, which is that the project design has to be rock solid, and we look into all of those important aspects related to the community activities and the revenue sharing, of course, and the project activities and the multiple streams of income. Carbon is one income stream that's really key here. And of course, we have to secure those high prices of carbon to make sure that income stream comes in. But in order for us to get high pricing of carbon, we also have to make sure that there's all sorts of other robustness in the project, and that's really to the sustainability of the projects and the design and the capacity on the ground. We also like to see projects that have multiple income streams, because we want them to be long-term and sustainable as well. And then, as I mentioned, also, to get to that kind of those high prices, and to get to that scale needed, you need to leverage all of that technology and make sure that there's a lot of streamlining in place.
If I can build a little bit on that. So the idea, well, when we talk about benefit sharing, there is no, I would say, right number. Is it 60%, 80%, 12%, whatever, that has to come back to the community? It depends on the profile of the project, how much money is needed initially, when are the revenues going to kick in, etc. Because we cannot just antagonize the investors and saying that they are big sharks. I mean, in the end, we don't do anything without money. So thanks to their money, we can kickstart a lot of pretty nice activities on the ground. So the idea is that there's no right number. We tend to like to think about how should we spend this money that is part of the equitable benefit sharing plan also. Meaning that, for example, what we like to do and what I've seen, well, we got inspired by other people as well, but they were in the OPEX of the project, so the activities budget and operational budget of the project, putting an envelope, fixed envelope, so no matter what the carbon price was and the benefit in the end was, this envelope was kind of secured as an activity of the project to kickstart sustainable business with the community. Meaning that for the first year, for example, if we would invest $1 for, well, just $1, no matter how many carbon credits or trees are planted or whatever, just $1, make sure that 3 years down the road, this dollar has enabled us to enable the community to generate $5 because of this sustainable business that had kicked in. And so in the end, those $5 new, they're not part of the benefit sharing plan, but they were initiated through that. So it's also some ways you could see the benefit sharing. It's not only an instant and when there is revenue, how do we share it, but how we make it prosper in the future or even before, and how we can ensure it in kind of a market that is unstable, because we know that the carbon price is kind of volatile as well. And especially working with communities, if one day you manage to distribute a sum of money and the year after the price crashes, for example, and you don't distribute anything, it's going to be really hard to manage to keep up with the trust of the community and the engagement of the community. So the defiance, well, it's also about bridging this gap between the investor world and the defiance that developers or community can have towards this kind of money, to make everyone, well, on the same page, that without investor money we wouldn't be doing anything, and that if we manage to have this basis that doesn't change too much, we will manage to get people involved on the long run while having this money prosper, and not only I have received this money, I'm going to spend it, and then I'm waiting for next year benefit sharing to spend more money. So we're trying, I think it links to what Jessica was saying about all the designing of the project. Benefit sharing should be included in how much is spent, how it's spent, and at what level of the P&L or the balance sheet of the project it's being spent, whether it's secured, whether it's based on the last benefits. and all the activities, how much is going back to them.
Maybe I
Yeah,
can share
these are
the
all great points.
project.
Oh, sorry. Go ahead, Khalil.
If there's time, if I'd share the ironic project developer perspective. I just think this is such a good conversation and such an important conversation because I think that getting this balance right is so critical to the industry's success. On the one hand, like it's always been the dream of the conservation community to be able to bring in private sector capital into this space. You know, everyone talks about the size of the global budget of philanthropy versus private sector investment. And like, if we really want to bring the capital required to make real progress, meaningful progress on these solutions, we need to be able to bring in the private sector. We need private sector investment, and the private sector needs to be able to get the returns that it needs to be able to be attracted and brought into this space. So from like a pure conservation outcome perspective, we do need to be thinking, how do we make this work for the private sector? But the flip side is so equally true. It has to work for communities, or else if it doesn't work for communities, I'll go into that why in a moment. It's not really not going to work for the private sector. And so if it doesn't work for communities, it won't work for the private sector, and vice versa. And so like getting that balance right is so critical. It's important to get right on the community side for a couple of reasons. One of them, which is maybe the more superficial reason, but easy to understand, you as a buyer do not want to be caught in a situation where it's like revealed that there was some crazy unequitable arrangement that was brought forth, and like, you know, the community was more or less getting exploited out of this arrangement, and the project developer investor is taking like the lion's share of the whole thing. That's just not going to be good for business, right? So just from like a perception perspective, this is like maybe the vain but really important argument for it. But there's also the flip side, is that the project has to work and it has to be durable. And for the project to work and it has to be durable, communities need to benefit enough and completely be bought into the situation. And I really resonated with some of the stuff that you were saying, Victoria, about like it's not a one size fits all approach, and you need to sort of leverage other benefits from the project and other ways of bringing value to it. And this is just because at the end of the day, restoration work is about changing land uses. And changing land uses is really about changing people's decisions on how they want to use their land, right? And people, the way they think about how the way they want to use their land is almost always a question of livelihoods, of improving livelihoods. I've been working in this space for over 20 years, and I have never, ever met a land manager who said, my objective function is to optimize carbon sequestration. They talk about all sorts of objective functions. Carbon sequestration is at best a co-benefit in this whole thing. For the investor, for the buyer, that might be the primary objective, but their primary objective is not optimize carbon sequestration. Theirs is more livelihoods focused. And so I really do see carbon finance from the community perspective as a co-benefit that we need to bring in to kickstart another activity. And so when we think of changing land uses, we don't think about optimizing carbon sequestration. We take that as one consideration within many to get to a better outcome. So in agroforestry projects, land use projects, people are often going for something else, right? And you might be talking with coffee farmers and they're looking to grow a good coffee production crop, or they're looking to maybe look for a land use that like they're getting older and they can't put in as much family labor onto the farm, and they're looking for something that's a little bit less labor intensive. You know, there's all sorts of different objectives that people might be going about it, and you've got to think about that from that livelihoods perspective.
These are all such great points. And this topic of carbon revenue sharing is a really difficult one. And I would like to highlight the opacity in this sector around around the question of benefit sharing and the amounts that project developers or investors are working with. I think it's really hard to get data points around how much revenues are being redistributed. But I do agree that ultimately the number doesn't really matter, because you can, let's say you're sharing 70% back, you can include a bunch of different stuff in there, and it might not necessarily mean that it's a better livelihood value proposition. You can include, salaries or seedling cost, and these may not necessarily be perceived as a benefit to project participants, but they're just considered sort of normal. Salaries need to be paid, they're not necessarily a benefit. So really insisting on kind of separating out the embedded benefits of the project. So the sort of economic activity being created, the nursery operations, the salaries, and the actual carbon revenue share, which I think it needs to be spelled out a bit separately from the other benefits. But however, in terms of challenges, I completely agree with your point, Victoria, on the timing, the risk if the carbon price fluctuates in the future. How do you also explain that to project participants at the beginning when you are explaining to them that they will be receiving a share of carbon payments? They will want to know roughly how much. So can you say that ahead of time? It's really difficult, right? And also, yeah, the payments will only kick in at your first carbon verification. So is it okay or ethical to make people wait 7 years before they get their first carbon payments? Yeah, these are all really tricky questions, and it's important, I think, that this sector starts to more openly discuss them and address them. Um, so perhaps to finalize and wrap up this part before we turn to the audience Q&A, um, I just perhaps want to get a few final remarks on what are some of the best practices that community-led projects or smaller projects should follow in order to access investor capital. So we've talked about de-risking. Um, yeah, do you have anything else that you might like to share around making investors comfortable and helping them navigate their way and navigate their wallet towards these kinds of projects, as opposed to the bigger, more commercial, larger scale projects that we've talked about?
Eventually, I can start with a really simple thing is that a lot of developers, NGO, or even community start with the thinking that because it's a community-led project or because it's a smallholder farmer project, it's a good project, and that they don't need to prove anything to attract anyone. So, broad thing is that we like to treat those projects the same way we treat private owned land or more industrial kind of project, with professionalism. So even if it's a community-led project, you have to ensure that the land tenure is clear. You have to ensure that the FPIC has been correctly conducted. That and not only say, okay, it's been conducted, but really to be able to prove that. Because this is what we find with a lot of developers, that yeah, there is this concept that anyway they're doing it for the good of the people and the planet, so they don't have to prove it. But they should, because this is what investors are being scared about. It's the how fragile this project can be if the community decide not to honor their contract, for example. Then what? If the community one day claims that they didn't understand what they were signing, then what? And what can you do once you have invested millions in the project and from one day to another the community doesn't want it anymore? So in the concept, make sure, well, we've been implementing this good practice, for example, that for every community contract we sign, we ask them to have a lawyer or a legal advisor to have them explained, not by us because there is a conflict of interest, of course, but by someone else, what's in the contract. Because this is what we would be doing with a private company. If we were developing a project with a private company, it would take a lawyer to have all the contracts rounded up and done in a more balanced way. So yeah, it's a really broad thing, but to try to have it as professional and bulletproof as any other kind of project. And it's not only because it's community that it's necessarily a good project, especially knowing that it scares investors off. There should be an additional layer of diligence and rigorousness and proof and papers and to to try to fill in the gap of the trust of investors right from the beginning somehow.
Yeah, I could add to that. I mean, what you said, Victoria, really resonates with us. I think there's, investors at this point are going to really dig into details. So I think, to the extent that there's a lot of transparency up front, I think that that is extremely helpful. But also, for us, and I think any investor, they need just there's a long list of information that we need, so very clear and well articulated cost models and project information and risk assessments, and if feasibility reports have been done, then that's helpful. And maps, all of that is kind of, we immediately need just a huge amount of information to even begin to think about a project. So assembling very transparent, good, solid information is really key. And then, yeah, a plan that kind of shows that those key challenges that we've discussed earlier in the panel, that there's a strategy to kind of de-risk and to address some of those issues. So that kind of goes into the, sustainable systems and the robust project design and the community engagement and the capacity building and the consultation plan, and then leveraging local expertise and streamlined approaches related to technology and remote sensing and other kind of technology. So just, we're looking for a lot of ways that really show us that that the project is going to be successful. And there's a lot of things that need to be addressed. And so I think we just need kind of a very, very comprehensive package.
Thank you for these remarks, and I think perhaps now is the time to jump to our audience questions. I think I've seen that you have that some of you have suggested some really interesting questions, more perhaps a little bit more specific around the kind of funding, the financing structures that are suitable for smaller projects, for community projects. Um, so perhaps, yeah, if we can get a little bit more specific now in our discussion, and think about what are the kinds of financing structures that are suited to these kinds of projects, and how can a smaller organization, a smaller NGO, for instance, access that funding. And I think I will add on top of that a question around um, the level of aggregation that perhaps is needed to come to an acceptable project size. Like, no one is going to contract or procure credits from a farm that is 10 hectares alone, right? So perhaps hummingbirds, and taking root from your perspective, do you have a role as an aggregator, also kind of pulling together some different land stewards into a project? And perhaps is that a way to help the smaller land stewards, the smaller landowners, access carbon markets and participate in carbon finance? Um, I hope it's not too broad, the question.
I can start, well, or if I forget any part of your question, don't hesitate. So, but really transparently, hummingbirds on our side for what we call the ARR projects, we are looking at a minimum of 5,000 hectares with a potential to go over 10,000 hectares, because we know that there is some fixed cost for the certification, for the monitoring, for everything that will be the same indeed for 10 hectare project or 5,000 hectare project. So again, the whole potential of those community-led projects or smallholder farmers is for me the scalability, but we cannot start too small. So aggregation is key. It's really important as well to try to have some kind of collective responsibility that works really well on the long run. We've been experiencing that if you give too much responsibility on individuals, it's getting really complicated to monitor everything and everyone and sign one contract with everyone, rather than when you manage to have farmers, a community make small groups, they have to watch one another to make sure they commonly all together comply with the level of performance that is expected from them. And this is really a virtuous circle. And that is a really good practice that we've been experiencing on the ground. so that you need a little bit less monitoring, or you don't need one agent that goes on the ground every day, see everyone, because they are getting all together, the ambassadors, one of another, and ensuring collectively this performance. So yeah, minimum size, not to start too small and to have those fixed costs, be disproportionate compared to the rest of the budget, and to have some kind of responsibility to be able to better control this cost while ensuring the performance. And as just you were talking about the different financial instruments that could be used, I'd say they're exactly the same that the one that could be used for private owned land or bigger industrial kind of project. It depends on the size, it depends on the context, but we've seen community projects, investment through SPV and equity and shareholder loan and debt instruments, kind of really classic, I would say, or the project that goes only through ERPAs with prepayment and then trying to secure long-term purchase agreement. And of course, a mix of all the solutions is always the ideal proposition, but not always easy to find. But well, or at least from Hummingbird's perspective, we have never used nor seen a specific financial instrument for community project or smallholder farmers projects.
Great. And Khalil, and perhaps can you share a little bit more about the minimum size as well that you're looking for in your farmer recruitment process, and also the types of financing structures that you've seen work in your case?
Um, yeah, I can certainly speak from like a scale perspective from like a project developer. We have never actually received any investment, and so I don't know how much I can speak to what works and what doesn't, but we're certainly trying to figure that out. So I'd appreciate any insights from that process. Um, as I've sort of said multiple times today, we don't view smallholder projects as small projects. In fact, we view them as the projects with the greatest scale potential. We think of them as directionally really, really big. In fact, they're often more like programs rather than projects. We could think of a program as like a collection of projects to get scale. We found that the way to make these things cost effective and scalable is to standardize processes that lend themselves well to standardization so that you can replicate those learnings and do that scale while being flexible at the community level. And to be able to do that, there are a lot of fixed costs. There are a lot of fixed costs to go into a region, especially when you're starting. Like I was talking about recruitment earlier, it takes a certain critical mass of the sort of the flywheel effect to get going. And so we think of projects as like going into new areas. We think like, okay, well, we probably should be thinking much more than 10,000 hectares, but if we don't have a game plan to get to 10,000 hectares, we won't even go into a new region. Community today is at like over 20,000 hectares and accelerating at a rate of 4,000 to 5,000 hectares a year. So we're certainly thinking about that scale. The two cautions I would say is that, well, we want scale, and I think everyone wants scale. There is a delicate balance at the speed at which you can achieve scale responsibly. I would love to start year one at 10,000 hectares. I think it would be like organizational or project failure to think you could do that at that rate. There just is a maximum rate of like human learning velocity and human acceptance into a new idea, into a new region, and new community, which limits your ability to go too fast. And so you really have to balance getting to the scale that you need for like economies of scale and cost effectiveness versus like the community's rate at which it can scale. One strategy to dealing with that, which actually makes it more expensive upfront, is that you have to start in many places at once, provided you have the organizational capacity to do that, so that your sort of rate of acceptance within a region, while that curve we might start small and start picking up. If you can sum that slow curve in lots of regions at the same time, you can get to scale quicker, obviously, but then it increases your needed for upfront costs. And then a second big tension I would point out where I think they're fundamentally different communities projects opposed to industrial projects is like there's no land ownership, and so there's no way any smallholder project is going to responsibly use the land as collateral. Just can't do that. Like just ethic, it's a non-starter, and that is an added challenge, of course, where like a lot of people, especially with debt instruments, talk about the need for collateralizing the investment with real assets, and that's just completely off the table in these types of projects.
Yeah, that's a really good point. And listening to you, I was thinking about a useful resource that I came across recently on the different types of financing instruments that exist for carbon projects. It's a resource by the World Business Council for Sustainable Development, WCSD, um, called the Investor Guide on Natural Climate Solutions. And I would really recommend perhaps the audience who is interested in learning more about financing structure take a look at it, because they outline equity, SPV, carbon streaming, carbon offtake agreements, spot sales in a quite simple way. So you're able to understand what are the different instruments that are available for investors. Um, as perhaps a first step to figure out from a project developer's perspective what instruments would be more suitable. So that just came to my mind. Um, on I have a question for Jessica from the investor's perspective here. What is your entry point when you look at investing in a project? What is your acceptable risk threshold? Because we often see a lot of projects that are in the biggest need of financing are those that are early stage and are looking for the very early stages of pre-feasibility financing or feasibility financing. So where does Mercuria stand in that? And what level? Yeah, what is your entry point, your investment entry point?
Yeah, that's a great question. We don't really have a hard and fast rule on that, but we often and you mentioned all the different structures that an investor can enter this market in with, and we basically also kind of operate in all of those structures. So equity, not as much debt, but equity, and certainly just direct offtake, and other things as well. So we, there's a variety of kind of different activities, but we often and usually will enter into a project before development, so very early stage, and as long as there are good partners and a good plan in place, and it meets all of our due diligence and kind of KYC requirements, then we're quite happy to enter at very early stage. Um, so yeah, we'd rather that because in a way it's beneficial because there's kind of more of a partnership there. We can kind of enter in as a partner in the early stage project, create an SPV or whatever it is, and then we're along for the ride for many years. But we also will just enter into a direct. I mean, we're a trading company, so obviously there's a lot of spot deals as well. But we can do very early stage investments.
Okay, thank you. Yeah, I do think that question of entry point is important because not all investors are able to take venture capital risk and invest in a project at the very early stage, the concept level stage where there is no even carbon feasibility study that proves that the project can generate carbon credits. So there is an initial investment that or financing that needs to be found somehow in order to be investment ready. So this is where I think there still needs to be work. Work needs to be done. There are a number of sort of technical financing facilities out there, or grant making facilities and programs that are there to support the, the younger projects, those that maybe have restoration experience but no experience raising carbon finance. I'm thinking about the WRI's financing facility AFR 100 for African restoration projects. I'm thinking about the Plan Vivo Accelerator. I think that's also a really promising and interesting idea that needs to be pursued for for projects and increasing the supply of investment-ready projects. But curious to hear from any of you three if you have any more thoughts around how can this kind of capital, early stage capital, be accessed? Have you seen anything that works for perhaps carbon feasibility studies when the project developer doesn't have the balance sheet to to conduct those studies and these activities themselves? So it's a
Well,
hard question.
on our side, at least, it's a little bit our raison d'être, as we say in French, meaning that we bring this financing to the really, really early stages. So we do have some people that come with only, okay, I have some lands, I don't know what to do, I don't know about carbon or whatever, and we bring this technical and financial support to bring the project to market. So through the different stages of idea, well, to really a concept note or idea note until having a project certified. And as of how we choose, because the idea is not to have everyone knock on our door like just, hey, I want to develop a project. No, it's true that we do have some no-goes or some green lights. Unfortunately, there are some countries where we would not be able to go because some countries are too. Well, we want to be able to send our colleagues, for example, and make sure they will come back alive. So the security is one of the big issue that and big topic we are looking at, for example, as an entry point for a project. And we favor or we value a lot the local anchorage and operational track record of our local partners, meaning that if an NGO has been working with thousands of farmers and they know how to plant, they already have the network, they know how to convince them to move to agroforestry, but don't have a clue about carbon, that's not a problem. And we value more the on the ground knowledge, I would say, rather than the theoretical carbon knowledge. So, and I know there are other actors just as we are that are ready to take really early stage risks. Because it's true that from time to time, even grants, when you are an NGO, a first time, a first company, first project, it's not that easy to have a reliable file or to get them to really trigger this kind of grants. Or it can be kind of long.
Yeah. Yeah, I mean, I guess I would just kind of give a little bit more color on the way we work because just like Victoria, it's very hard for us. We do have no goes. We're not able to invest in every project that comes with us, even when they're good. And part of that reason is kind of just the way we work. So there are certain countries where we just have nobody on the ground, you know. So for us to, and it would be unusual for us to enter a country and, you know, finance a feasibility study and invest in a single project, but rather we would kind of prefer to create a cluster of projects. And the way we do that is to make an equity investment in a local partner, and then they help us by developing those projects and also originate for us. So that's why they can help us vet projects at the early stage and leverage their own existing networks and partnerships on the ground that we wouldn't otherwise have, but we would much prefer kind of clustering in geographies where we already have those boots on the ground.
What are these geographies out of interest?
Well, currently we have an equity investment in a project development company in Peru, Mexico, and Brazil. So they do origination for us. So I mean, if someone listening was able to talk to some of them, then maybe we would hear about their project, but it would be much harder for us to develop, you know, on a kind of feasibility level, on a project by project level. If that makes sense.
Great. Well, thank you very much. I think we are nearing the end of this session. I think we covered quite a lot of ground, but at the same time, there is always more to say. And I hope it doesn't feel like we're cutting short the discussion, but this is a very important topic. How can projects access capital? If we're talking about it today, it means that no one has the magic key or the magic answer to these questions. But I hope that some of you will try and we'll get away from the session with a few more insights about real experience that our panelists shared. And I would also encourage you to look at or research existing financing facilities that perhaps exist to support the very early stage projects before they are investment ready. But yeah, there are also a number of resources that describe a little bit more what investment ready look like. So I mentioned this investor guide for natural climate solutions. I found it quite helpful because it also helps investor develop due diligence questions to ask projects. So if you're a project developer, you may want to know what kind of questions investors are likely to ask you, so that you can also kind of prepare yourself. And you will see that the topic of benefit sharing and equitable project design is very important, perhaps more so than you thought. I think investors are putting a lot more emphasis on it now. But I will thank my the 3 panelists. I think it's been really fantastic. We are just 5 minutes before the end of the session, but I think perhaps everyone is keen to get 5 minutes back from their day. So again, thank you so much for joining this session today. And thank you, Khalil, Jessica, Victoria. It's been fantastic to share this session with you. Thank you,
Thank you so
and
much
good night.
for moderating.
Or
Much. Bye.
bye bye.